Okay, once again, this is Alan Gassman. We're going to get started with this webinar. I have Professor Jerry Hesch with me by speakerphone. You'll hopefully be able to hear him okay. Thanks to Elaine for telling me that you could hear me, and I assume you can see me and see the slides. And for the first hour here, we're going to talk about the important details for this new tax act. And I'm going to concentrate on planning opportunities and planning challenges, which is why it's important that Professor Hesch is here with me. Then I'm going to spend the next 60 minutes running numbers for you, showing you, and also we may not go 120 minutes. We'll see how long I last. And then we're going to re-enter at 1:15, and I'm going to have one or more of our computer programmers with us. We're going to show you, or anyone that want to share this, the state view for the $15 million exemption and a couple of other things, and I'm looking forward to showing it off. This presentation does qualify for both Florida and New York continuing legal education credit. New York has reciprocity with Florida, which is a nice thing. And if you want to send us an email to get a certificate, just let us know. The CLE code is 2507820N, as in nothing. And one nice thing about Florida and New York is they do not require polling questions, so I did not have to get Matt Polling here with us to talk. If you'd like a 10-day free trial of Estate View, please let us know, and we will be delighted to share that with you. Let me change my phone there. And Estate View at this time still on sale, $4.99 until we get all systems going with the artificial intelligence, which is coming along really well, and also our instant view, which is coming along really well. So to go into the tax law changes, my partner Brandon Ketron did a fantastic job writing this up so that I could use it and take full credit for it. But the most expensive thing to the US government is that the pre-2017 tax brackets and the pre-2017 standard deduction have gone away in 2017 and are now extended. So this 37% highest tax bracket and the brackets beneath it, and the fact that every married couple filing jointly gets a $31,500 standard deduction, whether you have these deductible items or not. So even if you don't have a single dollar of medical expense or state and local taxes, including your property taxes, and you have no charitable deduction whatsoever, you still get this $31,500 deduction. Yes, Jerry?
Um, yeah, that's fine. I'm going to make a comment later when we talk about people who make substantial charitable contributions and how you can get the standard deduction and get the full charitable deduction. But not now, a little bit later.
Perfect. So people will be hanging on to watch that. For a single individual, that standard deduction is $15,750. You want to remember that at the cocktail party. The personal exemption is gone. And then people 65 years or older get a $6,000 deduction. This does not make Social Security tax-free. For some people, it might, this $6,000 deduction. If you get $6,000 of Social Security, I don't know anyone who does, and your adjusted gross income is less than $500,000, then you may, or less than you may, get free Social Security. Otherwise, most of us are going to be paying tax on at least a part of the Social Security. I think the formula is 85% of Social Security. The Social Security office sent out a erroneous notice right after the law was signed saying hooray, hooray for this tax act. So there's going to be a lot of disappointed senior citizens relating to this, but maybe a subsequent bill will correct it. Who knows? I can imagine it would be very expensive. A $600 billion tax extension and expansion savings for taxpayers is the child tax credit. I believe 1,600 or 1,800 per child is refundable, which I think means you just get a check in the mail if the credit exceeds what your tax would otherwise be. And this doesn't start phasing out until $400,000 of adjusted gross income or 200,000 for a single person. So that's certainly an important part of a lot of people's finance. So they did cut back on a lot of social programs, but this child tax credit, if you think about it, giving every mom $2,200 that per child a year, that is a little bit of a social program.
Alan,
Yes.
question. Who can qualify as a child?
Well, I've been told that I'm very childish, but I would think it would be somebody under 18 who's listed as a dependent on the tax return.
Well, that's a question, because what happens if you have it's obvious that under 18 can qualify as a child, but what about a child who's over the age of 18 and in college? Can they qualify as a child?
I wouldn't think so, but I wasn't told that.
Right.
Do you think they would?
It's an interesting question. We talk about child, but what's the definition of a qualifying child?
Yeah. Okay, we'll find out and add that to the slides.
All right. I was curious about that.
Right. So we're going to talk in depth about the qualified business income deduction later, but just to start refreshing memories, in the 2017 Tax Act, they reduced the corporate rate way down to 21% for federal. So to do something similar for other businesses, they put forth a 20% tax deduction for business income of many businesses. And if you're a taxpayer and you have total income of less than about 400,000, you're only going to pay tax on 80% of your business income. But if you're a higher earner, this deduction goes away if you are in the trades, if you're a doctor, a lawyer, an actuary, a CPA, they call those certain types of SSTB businesses. Or if you are not employing enough, if you don't have enough of your payroll going to employees, or you don't have enough property in the bill. So we're going to talk about this and how you can spray income or share income with lower bracket taxpayers to save a lot of money under Section 199A. Number 7, the estate and gift tax exemption was permanently increased to $15 million starting next year. So while we were all up until the election, we were feverishly working with as many clients as we could because the exemption was going to come down from $13,990,000 to $7 million something. That day is gone. Instead, it goes from $13,990,000 this year to $15 million per person next year. So Marcia and I now have a total estate and gift tax exemption of $30 million minus any large gifts that we gave in the past. And we've only given the gift of laughter in the past and educational expenses. So we've never used any part of our exemption that we can remember. So this is going to have a big change. And the big change is, how do you address people who were going to have estate tax and now have irrevocable trusts and have estate plans that form irrevocable trusts? And none of these irrevocable trusts that I can think of, are very, very few of these irrevocable trusts will allow for a new income tax basis on death. So Clyde died 6 years ago. We've got $7 million in a credit shelter trust for his wife, Bonnie. And Bonnie has no estate tax issues anymore. She's well under 15 million. And when she dies, you have $7 million worth of assets. And when they sell those assets, a big capital gains tax. So what are we going to do when Bonnie dies to get that new income tax basis? And that's part of what Jerry and I are going to talk about, just to whet your appetite. Number 8, and this is very important to people who have more than $10,000 a year of property taxes. The 2017 Act reduced the property tax limit. An individual can only count $10,000 towards their standard deduction for property taxes. So this year, if I have 25,000 of charitable deductions and 40,000 of property taxes, under the old law, I would only have 35,000 of total deductions. It wouldn't exceed my standard deduction, so it really wouldn't do me any good. But now I'll have up to 40,000 of those taxes, so it'll be over the 31.5. So that's an important thing, but it phases out. So if you make 600,000 a year, you're still limited to the $10,000. And we're going to talk about ways around that, because they did not put this limitation into trusts. So certain what we call non-grantor trusts may own a vacation home, may get a lot of bond income, and may just use that bond income to pay up to $40,000 of property taxes. And then that's a deduction that the original owner of that vacation home would not have had. Jerry, anything to add to that?
Well, what's interesting, so if you make $500,000, that exceeds, if you make 600,000, that exceeds the 500,000 excess by 100,000. So 30% of that 100,000 or $30,000 phases you out. Uh-oh. So essentially, for people who make over $600,000 a year, the deduction is $10,000, period.
Yeah. So we're going to all be thinking on our feet with respect to this. And it's for this year. It's for this year. So it may be time to move that vacation home and move those bonds into a non-grantor trust as quickly as you can to get as much of that income spent towards those property taxes in 2025.
There's an underlying theme that is going to permeate everything we do. And you have to remember that individuals are separate taxpayers. As a matter of fact, a husband and wife are separate taxpayers for federal income tax purposes, even though they file a joint return. But non-grantor trusts are also separate taxpayers for income tax purposes. And therefore, what we're going to talk about is assigning income and assigning deductions to other taxpayers, such as non-grantor trusts. And it's a theme that's going to permeate everything that Alan and I are going to do this morning. Okay.
And there's some very smart people on this webinar, so please feel free to send me an email or a question so that we can read your question, because there's some really smart people on this webinar. The next thing, just so everybody knows, I think I skipped a page here. All right. Alternative minimum tax is still a very high amount as far as the exemption there. So thank heaven we don't have to know about it, the alternative minimum tax for very many of our clients. Next, now when you buy a new home, new or used, the interest on up to $750,000 of acquisition indebtedness is going to be tax deductible, So that had been at $1 million, now it's at $750,000 for a qualified residence, which I believe would be a home or a vacation home, and maybe a reason to borrow that you wouldn't have borrowed before. And Jerry,
Alan,
go ahead.
I got a question. So I have a $500,000 mortgage, and the interest for the year on that $500,000 mortgage is $30,000, which means I can deduct all that interest. Okay, acquisition indebtedness. Now, the common sense meaning is that's what I pay when I bought the house. But what if I put on an improvement and I refinance the house from 500,000 to 750 to put on a big improvement. Is that improvement, which increases, it's an improvement is increases the house like a new addition, not a new roof. Is that also acquisition indebtedness?
I wouldn't think so, but I don't recall. But it's not an acquisition. What is the
Right.
answer?
I don't know. Look it up.
That's the great thing about being a law professor. That's why they did it that way. They don't actually have to know anything. They just ask
But
questions.
what's important is in the Internal Revenue Code, every term supposedly is defined. So when they talk about acquisition indebtedness, look at how it's defined in that limitation. And I think it includes the amount you spend on improvements, not repairs and maintenance, but improvements. A new roof is a repair. A new furnace is a repair. But if you're going to put in solar energy, that's an improvement, and that could qualify, I think. But look up the definition.
And speaking of solar energy, all of the solar energy tax incentives that I'm aware of will be gone if you don't get it done or at least get it started this year. And Marcia and
Well,
I
now,
have solar on our home and our vacation home, and our power bills have gone from $800 to $900 a month to $50 to $70 a month. I'm glad we put them up while maybe there was some incentives.
on solar energy, it will still qualify for the solar energy tax credit if construction starts within 1 year after the July 4th, 2025 effective date. So that means you got a year to get your solar energy project. However, unfortunately, what Congress gives, they then take away because there's an exception that says if your solar panels are bought from China, it ain't going to get the credit, even though it's within the 1 year. And where are most of the solar energy panels manufactured?
China?
Right. So essentially, they give it to you in one way and take it away in another way.
Usually it's the large print giveth and the small print taketh away, but here in this tax bill you have some large print giveth and the small print giveth more. So on we go. Section number 11, casualty losses no longer deductible unless you're in a federally declared disaster zone. So maybe that becomes a little bit political. Number 12, miscellaneous itemized deductions. They're gone, so we don't have to worry about knowing about them anymore.
Here's something that's very important, Alan. If you have a normal expense that is in your trader business, that's not a miscellaneous itemized deduction. But if you have certain investment expenses that are deductible under Section 212, which allows you to take deductions for your investment expenses, you get the deduction under 212. But guess what? It's a miscellaneous itemized deduction.
So you don't get it.
Yeah.
But if you have an active trader business on your Schedule C of your income tax return, or an S corp, or a partnership, or a C corporation, wouldn't that be deductible as part of
Yeah, that's
active
a trader business. In other words, individuals who are self-employed file a Schedule C for an active trader business. So essentially, if you have certain investment expenses, you might not be able to deduct. But just be aware of it, and if you have a choice of treating it as an investment expense or a business expense, make the choice in favor of a business expense.
Right. Jerry, can you explain the 237th rule?
No.
Okay. I don't feel as badly then. All right. Here's a tip for everybody. The no tax on tips came through, in other words, tip income can be deducted to the extent of $25,000 per taxpayer, but it starts phasing out at 150,000 single, 300,000 joint filers. So it will only apply to traditional types of work that normally bring tips. Those are going to be released by the Treasury Department. Certainly servers, bartenders, car parkers, etc. You know, when you park your car at a hotel, the hotel or an entity associated with the hotel normally gets part of the tips from those people, and they may also, if it's a proprietorship, the person who's taking the tips off the top, not necessarily the one who's parking your car, the entrepreneur may have some tax-free income as well. So if you represent people who have those concessions, you may want to read this bill and do a little bit of restructuring, if that's possible.
Alan, another question on the definitions. I report I have $35,000 of tip income, and I'm not going to get phased out because I don't work at a fancy steakhouse. All right. And by the way, I went to a restaurant the other day, and they said we had this wonderful prime rib, rib steak, and it was a 12-ounce rib steak was $85. I had a Caesar salad. But here's what's interesting. That $25,000 deduction, I don't think it's an itemized deduction.
Right. No, it's not. It's off the top.
It's off the top. So that means you can take the standard deduction, but the $25,000 deduction is from gross income before you and used in computing adjusted gross income. So it's off the top. So even if you take the standard deduction, you still get that $25,000 deduction.
Right. And then the other one, which is very similar, is up to $25,000 with generally the same phase out for overtime compensation. Now, it's not if you work the 41st hour and your overtime compensation is $45. It's not the whole $45. It's only the $15, the and a half. And I went around my office and I told everyone, I am so happy that your overtime will not be taxable. Now you can work more overtime, right? And they all said no, that we're not going to be motivated by the fact that we'll be able to get basically an extra 30% of what you would normally would have paid us. Now, as the employer, I still have the employment taxes. They still have the employment taxes, but they do get an income tax deduction above the line equal to up to $25,000 of overtime. Now, does that mean I should start paying myself overtime as the owner of an S corporation? I don't recall any related party rules there. So, but if you're a lawyer or a CPA, you're immune from overtime if you have your license. But your children are not immune from overtime, so there might be a little bit there to do in the family. But the main thing is people who work harder pay a little bit less as a percentage of taxes, which that one doesn't bother me. Jerry, any comments on overtime?
Well, there's an interesting little thing. What employers used to do is, in order not to pay them fringe benefits and everything, they would basically say you're part-time, and you only work like 32 hours a week. The Department of Labor figured that out, and the definition of somebody who works full-time is now something like 26 hours a week. Okay? So essentially, is you have to pay overtime compensation for full-time employees. So if you have somebody who's working more than 24 hours a week, you have to figure out what is going to be overtime. And the definition of overtime should be, I'm going to pay you. You work 24 hours a week, and I'll give you I'll give you $240. I'll give you $480 a week. Okay, so essentially, but if somebody is not a full-time employee, can they qualify for overtime?
Oh, I didn't realize that. That's interesting. Well, we'll research that and put it in the outline.
Yeah,
I learned new
I'm
something
just
new
thinking.
every day.
I'm just thinking of these things as it comes along. It's
Yeah,
interesting.
it's great. Okay, section 16. Somebody with less than $100,000 adjusted gross income who buys an American-made car gets a tax deduction on the interest attributable to 10 grand. So 10 grand times 9% at most, I would think. I'm sorry. Yeah, 10 grand times 9% is $900. They get a $900 tax benefit, and they're in the 20% bracket, so they save they save $450 from this provision. Hooray, hooray! I mean, it's not bad to save $450, but I don't know what it costs the U.S. government to administer another page of the tax return for this. Section 17. This is very exciting. It'll be really interesting to see where it goes. Each governor in every state can designate 501c3 organizations who will be able to give scholarships. And I read it to be people who are no more than 3 times the poverty level. So if the poverty level is 50,000 a year, the scholarships would go to people in households of 150,000 a year or less. And I'm more than glad to write my $1,700 check. I'm more than glad to loan $1,700 to 10 of my friends who can all write $1,700 checks to help children get better schooling. And all the money comes right back, and then my friends can repay me. I don't know if that would work or not, Jerry, but it'll be interesting to see how many of these get funded and how many children this helps.
Yeah, but remember, you lend it to 10 of your friends, and when it comes time for repayment, they say, "Oh, Alan, I had some extra expenses. I have to skip this payment."
Right, I'll have to have a bad debt deduction then. I'll have to bunch them all in one year. So then section 18 here, and Jerry, I don't know if you want to talk about this, but they did charity a little favor by saying that anyone, even who itemizes, gets $1,000. The first 1,000 you donate, it's deductible. You don't have to worry about the rules. Married couple up to 2,000, it's deductible. So for people who donate 1,000 or 2,000, that's great. And for charities, that's certainly not going to hurt anybody. But on the other hand, the silliness but you can't count 0.5% of your adjusted gross income. So if I have adjusted gross income of $1 million and I donate 100,000, I can't include 5,000 of the 100. That's just irritating. 5,000 times 37%. It takes away $1,500 a year from somebody who's charitable. Jerry, any?
It was basically they had to have a revenue offset, and someone came up with this obscure rule.
Oh, so the what they lost on the 1,000 and 2,000 deduction, they make up by getting 0.5% from the big gifters.
Exactly.
Well, that's a pretty democratic thing to do. Now I understand that better now, and I'll have the law clerks check and see if that caused it to be revenue neutral. And then for cash donations, you still have a 60% of adjusted gross income. And Jerry, something neat is I do have a state view. When you put in Joe Biden's tax return or Elizabeth Warren's tax return, it will tell you what their charitable deduction limits would have been. So that's another new little calculator that we're working on.
Now here's something interesting. There's a lot of people who are retired and they don't buy when they downsize, they don't buy a replacement residence. A lot of them go into independent living facilities. Okay? And remember, Alan, next year when Jonathan and I move into an independent living facility, you promise to come visit us.
Exactly.
But here's what's interesting. I don't have any mortgage interest deduction or property tax deductions anymore. So essentially, I don't really have any itemized deductions. And I'm married with a $35,000 standard deduction. And I want to give more than $2,000 a year to charity. But the point is, I take $2,000 above the line, but I don't itemize. So if I give more than $2,000 a year to charity, I can't use that charitable income tax deduction. So what would I do if I want to? So could I create a non-grantor trust with some income-producing assets that will give the excess money to charity?
Right. If you want to give $50,000 a year to charity, you could put $1 million worth of taxable bonds into a non-grantor trust, have it receive the $50,000 a year of interest at 5%, and then have it pay the $50,000 to charity, and then you won't be having to pay tax on that $50,000, and then you could throw your vacation home in there too, and put more bonds.
Interestingly enough, I have a client who was not my client. It was the mother of a friend of mine, and she lived in an independent living facility. Okay, and she was using the standard deduction and giving about $5,000 or $6,000 a year to charity, and she could only use $1,000. So we basically shifted some income-producing assets into a non-grantor trust for the benefit of her children, and it does. So therefore, the rest of it is the charitable deduction is shifted to the non-grantor trust.
Right. So we're going to go through, in our law firm, we're going to go through hundreds and hundreds of trusts and think about, well, this trust is a grantor trust. It's disregarded for income tax purposes. It has stocks and bonds, and it owes the grantor $6 million. Let's repay the grantor with all the appreciated assets and equities. Let's leave the bonds in there. Let's reverse the trust so that it's a non-grantor trust. Let's put the vacation home in there, and let's have it make all the family's charitable distributions, and let's have it distribute also its other income to the lower bracket descendants. And that's what we're going to be. That's going to be a big piece of the menu that we're going to talk about later.
See, the key is wealthy individuals. By the way, in the old days, we used to talk about wealthy individuals. But then everybody said, I don't do estate planning for wealthy individuals. I do estate planning for high net worth individuals. But that wasn't good enough. Now I do estate planning for ultra high net worth individuals. What can I tell you?
Yeah.
But what Alan made was a very good point. A lot of people have second homes, and they're paying real estate taxes on the second homes. And the bottom line is, all these limitations that we talk about only apply to individuals. So shifting income and deductions to non-grantor trust is very income tax beneficial because we can get around the SALT limitations and other things like that.
Exactly. And I think, people who are involved with charity, you need to go ahead and reconnect with these charities you support and see what they need and see if you can help them. Because with the federal funding cuts and now this disruption, and of course you still have the ability to move, if you're over 70 and a half, you can move your IRA investments directly to charity and not pay tax on those distributions. So that's going to be a little bit more popular because of that 0.5%. It's going to make just a tiny bit of difference for some people. So page 12, the Trump account, it was going to be the MAGA account, but they changed it to the Trump account. And if you do your paperwork right, your child born from January 1st, 2025 through December 31st, 2028 will have an account funded for them. The parent will be in charge of that account. It will be equities only. It cannot be invested as of now. It cannot be invested in bonds. You'll be breaching your fiduciary duty the day you get it by having 100% in equities, and you can't touch it until the child turns age 18. I think one of the things they're hoping for, and I hope, and I think it's a good purpose, is to force the family to watch what equities do, because they typically, more than double every 10 years. So the family's going to say, wow, that 1,000 turned into 2,200. Why aren't I doing that? So that's going to be good. But I think the bad part is there's not going to be enough warnings on the wrapper for people who put more money in, because you can put another 4,000 in. But when you finally take it out, which you can take out half at age 18, half at age 25, you have to take all of it by age 30. But no matter when you take it out, even if you spend it on school and buying a house and all that stuff, it's taxed at capital gains rate on all the growth. Whereas a gift to minors account in an index fund will pay a lower tax over time, and a 529 plan spent on education and now includes vocational education under this new bill will never be subject to income tax.
So Alan,
yes.
Let me do this in an example, because remember, the key is first state the concept, then give an example to illustrate, because remember, our function is to communicate this. Okay, so that means for each child, I can put, let's say I have a child who's 8 years old. So for the next 10 years, I can put $5,000 into an investment account of equities. And all that income that the $50,000 eventually earns is income tax deferred, correct?
Right.
And then when I distribute it for any reason whatsoever, it's taxable. So it's like an IRA, but it's taxable at capital gains rates.
That's right.
Yeah. So and then it has to be distributed. But remember that when the child reaches age 18 and you start distributing money, their capital gains rate may not. They can also, if their income is really lower, like if their income for the first year is like $25,000, what's the capital gains rate for only $25,000 of income?
Yeah, that's true. That's
zero.
Yeah, that's true. Right. That's true. I hadn't thought of that. So anyway, that's the Trump account. But some people have said, well, max out your 529 before you start putting in the Trump account. But some of those people are thinking you can only put 19,000 a year into a 529 plan, or with the 4-year forwarding, you could put 19,000 times 5 into a 529 plan. But the fact that you go, if I put 119,000 into a 529 plan, I've made $100,000 gift above my annual exclusion amount, or exemption amount, no exclusion amount. But the 100,000 brings my $15 million exemption down to 14,900,000. Who cares? And
in other words, Alan, what is it's 5 times 19? I want the annual exclusion to be 20,000 because
please,
it's easier.
I'm sure that's coming. I hope it doesn't go to 21,000.
I can make 5 annual exclusion gifts for the next. That's 95,000. And if I wanted to fund a 529 plan with $295,000, 95,000 is no gifts at all. The other 200,000 is a taxable gift. What better use of your gift tax exemption to put money in an investment account that doesn't pay income taxes? And interestingly enough, I do something called educational dynasty trusts, because a lot of our clients are grandparents. And when the grandparents have children, what's the most important function that the children provide as far as the grandparents are concerned?
Providing the grandchildren.
Right, grandchildren. So you go to a couple who that they're like 65, they have all these wonderful grandchildren, okay, and they want the children to bring the grandchildren down to Florida to visit them. So they say, hey, I want to fund your 529 plan. Come down to Florida and think about it. But here's the point is, couples, when they have grandchildren, are always concerned that their grandchildren will have the opportunities to go to the best schools that they want to get into. And what better way to do this by setting up 529 plans? We call them educational dynasty trusts. Okay? And what people don't realize is overfunding a 529 plan it's not really overfunding, because states say you can't make contributions once the 529 plan reaches $400,000 or $500,000. But you can put several hundreds of thousands of dollars into 529 plans. Think if you have 6 or 7 grandchildren. Okay, what better income tax shelter is there?
Right, and every year you can shift it to somebody else. You can shift it to a sibling or the child of a sibling. You could eventually get it to cousins. You could eventually get it to second cousins. So
now here's something else, though. So the grandparents, G1 is the grandparents. The parents are G2, and the grandchildren are G3. And the grandparents fund the 529 plan for a 4 or 5 year old with $295,000 for a 4 or 5 year old. That's going to grow to a tremendous amount in 15 years. And the grandchild, G3, goes to college, goes to graduate school, graduates, and there's $120,000 or $130,000 left in that 529 plan. And everybody thinks, oh, you have to take it out. Well, if you take it out, you have to pay a 10% penalty, and it's also reported as income tax. But the grandchildren, G3, can roll over to their children, G4. And all that the grandchildren, G3, has to do, since it's deemed to be their money, is they get the annual exclusions and they get the gift tax exclusion. So we always talk about educational dynasty trusts for your descendants.
Right,
and
you can be owned. Right, they can be owned by the dynasty trust. So I have many clients. They buy the 529. The trustee of the trust buys the 529 plan.
Yeah.
And then the trust. Now, Jerry, if I've got a grantor trust, I form a grantor trust. It's considered as owned by me for income tax purposes. It's irrevocable. It sets up a 529 plan, and then I pay $10,000 of tuition for my grandchild. Can that 529 plan then withdraw that $10,000 and just keep it in the dynasty trust, and it's a tax-free withdrawal if my granddaughter is the beneficiary of it? I would think so.
Wait. You set up a trust for the benefit of your child?
Yep.
And instead of using the 529 to pay the tuition, you pay the tuition directly.
Right.
So that's not a gift for gift tax purposes.
Right.
And think about this. My daughter just, you look at what graduate school tuition is, it's $50,000, $60,000, $70,000 a year. That's a lot of money, isn't it?
Yep.
Unbelievable. So what happens is the 529 plan, the child graduates from law school, and there's like $100,000 left in the plan, right?
Yep.
And what happens if the child withdraws, say, the child graduates from law school, takes the bar exam, and starts working in September? What's their income tax bracket?
You're right, a very low income tax bracket.
So they take the money out of a 529 plan. It's subject to the 10% charge plus taxable at their low income tax rate. So it's a way of shifting income from a high bracket taxpayer to a low bracket taxpayer.
Right. Right. So it's a great thing. So, and then, I get these clients who come in, their children are 5 and 6, and they're putting in just enough each year so that when the child reaches age 18, it'll have 500 in it. I just put 300 in it today. Let that 300 grow tax free. Don't just fund it ratably. I mean, I think it's grandparents can do that. You could set up a dynasty trust, full fund it for your grandchildren. And then if they don't behave, you can indirectly control that dynasty trust by telling the trustee, I don't think you should spend that on that child's college. So it's a great thing. So, but hopefully the Trump account, maybe future legislation will make it on par. By the way, please don't forget that once that account, once that 529 plan is 15 years old, it can also fund Roth IRAs for those children. So then, if the child has 7,500 of earnings, and the 529 plan is 15 years old, then that 529 plan can pop that much money into the Roth IRA up to a total of 35,000. So not a bad thing. So the bottom of page 12, I always get a chuckle when I get an email from a client who's on their own boat, which is a multi-million-dollar boat, or their jet airplane, and they send me an email, and the email says, please consider the ecology before printing this email. I always get a kick out of that. But the other thing I get a kick out of is that if you buy a $10 million boat this year, solely for charter purposes, and you spend at least 500 hours in the business of acquiring and conditioning and chartering that boat, or you spend 100 hours and no one else spends 100 hours, then you get a tax deduction equal to the cost of the boat. And if it's in an S corp, that deduction flows through to you. And then in January, you could make it a C corp and start using it and pay rent to the C corp, which will be in the 21% bracket. And then when you sell the boat, then you'll pay a lot of income tax, but it's a deferral mechanism, and it's pretty widespread. And it'll be, I would imagine, the boat market and the jet airplane market, it will get a little bit jolt upward.
Yeah. Now, interestingly enough, what Alan raised is, I take this. I have a $4 or $5 million yacht, and it's not a boat because they spend so much money on it. They have to call it a yacht. Remember that? And I can take the entire cost of that yacht as bonus depreciation in the current year. However, it's going to produce a tax loss, and it's subject to the passive loss rules. And the key here is very simple, is if you want to spend 500 hours a year managing that boat business, you qualify you converted the passive activity into an active activity. But what happens if you're the only person who manages it? So what about that $500 threshold if you're the only person who spends time managing it?
Now it's 100 hours.
100 hours. And that's not much. Because remember, and also owning a boat is a wonderful wealth depletion technique. All right. But the point is all these accelerated deductions. When you sell the boat, it reduces your adjusted income tax basis to zero. And if you then sell that boat for, say, $1 million, what's the character of that $1 million gain, Alan?
Ordinary.
Because it's 1245 recapture income.
That's right.
So when you got to tell people it's a wonderful deduction up front, but you better satisfy the passive loss rules, which a lot of people don't realize. But more importantly, if you have your exit strategy, you have to take into account ordinary income, not long-term capital gain.
That's right. That's right. I think the other thing to remember is that you should take your advisor out on the boat or the jet airplane one day. Don't forget that.
All right.
All right. Then there's liberalization of the R&D deductions going back, retroactive to 2021. Now, I'm not sure who lobbied who to get a favor here and how much that company is going to get in tax savings going back to 2021. But maybe those seats on the front row of the inauguration paid for themselves here on page 13. Page 14. I'm sorry, go ahead, Jerry.
No, I was just scratching my head. Don't worry.
Yeah, okay. Let me see what Brandon here has here on section 20. Okay, the 100% deduction for
let's go back.
Okay.
Bonus depreciation did not apply to buildings. It only applied to fixtures and equipment. And unfortunately, real estate developers who don't like to pay any tax say that's unfair that we can't take bonus depreciation for our buildings. So what happened?
Cost segregation studies happened.
Well, yeah, but people don't understand. Cost segregation studies only make sense if you're not going to be reselling the damn building within a short period of time.
Can you still do a 1030? So in other words, what Jerry's saying is when you buy a building, part of the building is electrical systems, plumbing systems, mechanical systems, an elevator, and that's all. Anything that's, I think, more than anything up to 15-year property, you can get an ordinary deduction when you buy the building, and that's good. Now, Jerry, if you die, that all goes away and you have a fair market value building, so that works well too. But if you go to sell the building, then you recapture that as ordinary income. But I'd rather have the deduction now and then repay it in 10 years because I've got the use of that money for 10 years. But Jerry, if I do a 1031 exchange, I don't think I have to recapture it. It just
no, it's a non-recognition event. The gain is realized, but it's not recognized if you reinvest it. So the point is, but then the other problem is if you want to get a step up in basis, you have to basically have it subject to in your estate. And after $30 million, you got 40% estate tax on the full value, not just the built-in gain, but also. So, basically, when you explain all these wonderful depreciation deductions, you have to also explain what's going to happen in the future if you have an exit strategy.
That's right. And then,
but let's go back to real estate developers were very upset that they couldn't depreciate their buildings. So what did they do for that?
I don't know. You tell me.
No, it's in your next slide.
Oh, wow. They can do domestic research and development expenses, or this one, the 100% deduction for qualified production property on slide 14. Is that what you're talking about?
Yep.
Oh, okay. Integral part of a qualified production activity, manufacturing, production, or refining of a qualified product. Would that include real estate development? I'll have to look at that. I thought that would be factories.
All right. Well, in other words, if the factory building, can that be depreciated?
Right. And then section 23 was interesting. Qualified farmland. If you sell your farm, then you pay capital gains tax in 4 equal annual installments. So they're almost encouraging farmers to sell their farm, but whoever buys it would have to use it for at least 10 years in order for so now when you sell your farm, you can defer paying the tax as long as the buyer agrees to keep it in farming for at least 10 years. So that's pretty interesting.
Mm-hmm. Yeah.
Okay, so then on page 15, oh, before I forget, so Jerry, if anyone wants to come to lunch with Jerry and I in New York City next Friday, we're going to be speaking Friday morning for a New York University Advanced Trust and Estate Tax seminar, which you'll be able to subscribe to also. If you send me an email, I can get you the subscription information, or you can show up live. And we're going to be talking about how to diversify appreciated investments, which can include real estate, stocks, and bonds without paying tax or deferring the tax. And Jerry, do you want to just briefly mention what we're going to cover, or just what we're getting for lunch?
In other words, a lot of people want to sell property while they're alive for one reason or another. The typical situation is an individual has a closely held business. He's nearing retirement. None of his children are interested in the business. And the individual says, when I retire, I'm going to sell it for cash. But let's do an estate plan right now, because I think today the business is worth $20 million. But when I retire 5 or 6 years from now, I think the business is going to double in value. So the typical estate planning lawyer says, let's do an installment sale to a grant or trust, which means carryover basis. So what we're going to talk about is ways to dispose of an asset and basically defer the reporting of the gain. And there's 3 ways you can sell an asset and defer the reporting of the gain. And one of them is, it's called a charitable gift annuity, and this is for marketable securities. You can actually sell your marketable securities to a charity in exchange for an annuity, and the realized gain gets reported as the annuity payments are received in the future. So it's a nice way of getting diversification. But we're also going to talk about using the installment sales to a related party non-grantor trust, and also using charitable remainder trust as an income tax deferral transaction. And the program is live, but it's also going to be available virtually, because NYU hired a company that will allow you to participate virtually.
But I think more important to mention is that we're then going to go to the Second Avenue Deli and order some really good food and talk more about tax law. So page 15, the 1202 exclusion for people who sell C corporation stock and pay 0 capital gains tax is expanded. And we'll talk a little bit more about it. But when a client comes to you and says, I want to start a new little business, I think it's going to really explode like they do in Silicon Valley. It's not an automatic S corporation. If it's a C corporation, and the stock was an original issue stock when the C corporation was being established, and no more than 75 million was invested as capital. It was 50 million 3 weeks ago. Now it's 75 million. Then somebody selling their stock a few years later will pay 0 capital gains tax if they waited 5 years and a couple of other requirements are met. And the amount that can be excluded is, what is it, Jerry? It's the greater of, it was 10 million that you could exclude. Now it's going to be 15 million, but it's also a multiple of the basis.
Right. In other words, if I form a company and I form it with, say, I have $185,000 capital contribution from my founder's stock. So the exclusion when I sell it over 5 years from now is 15 million, or 10%, 10 times your basis. Well, 10 times my basis of 185,000 is 18,500,000. However, most people when they form startup companies, it's mostly service capital, their ideas and everything, and they get other people to invest in it.
Right. So,
but here's,
yeah.
Yeah.
So if I invest, you said it's what? How many times?
10 times.
Okay.
10 times your basis.
Okay. So if I put 25 million in, then if I put 2.5 million in, then the first 25 million is exempt.
Right.
And then also, if you're about to sell it and your shares are worth 30 million, well, you give 15 million worth of those 30 million of shares to your child, and then they get half the money, but the whole thing is exempt. Or you set up a 678 trust for your whole family considered as owned by your child, put 15 million into that trust, you keep 15 million, now you have 30 million exempt.
But does the child have to own it for up to 5 years?
I don't think so. I think it has to just own it, probably under the step transaction doctrine. You probably want to do it before there's a binding sale agreement, but we don't think you need to have it 5 years. I think you can do
now,
it.
Here's something. Suppose I have an operating business that I formed that's been very successful, and I happen to have, and it's grown by retaining earnings. Okay? So my basis in my partnership interest is, say, $250,000. Okay? Or no, make the basis in my partnership interest $500,000. Okay? Can I convert that partnership to a C corporation and start the 5-year holding period, the date of conversion, and qualify as qualified small business stock?
I know that at least some of the commentators think that you can. I'm not sure that the statute is clear, but yes, it's a strategy that certainly can be worthwhile to pursue.
So with a basis of 500,000, my exclusion of 10 times basis is $50 million. So, the statute, it doesn't allow it specifically. It doesn't disallow it specifically. Okay, and we suspect that, and a lot of people are basically saying we interpret the statute, but we can wait to do that for further comment, further clarifications in like rulings and things like that.
That's right. Think about this though, Jerry. A 1202 company is a company that is engaged in an active trader business, and its assets are all mostly used, 85% used for an active trader business. So let's say that a large law firm sets up a management.
No way.
What's that?
It doesn't apply to income from services.
But a management can be a trader business.
That's separate. In other words, a qualified small business, if you look at the definition, it excludes all service businesses.
Right. But
lawyers.
But a company that manages a service business is not a service business.
Right. It's a management company.
So if you have a client with $100 million company and you want to set up a management company as a 1202 company managing your $100 million company, the 1202 company hires the management personnel. It manages your company and a couple other companies, and it invests the profits into billboards, a billboard advertising business. So then when you go to sell your $100 million asset, your $100 million company, you say to the buyer, would you mind paying $20 million for the management company and $80 million for my manufacturing company. And the buyer says, well, if I have to, I will. And then you have 20 million tax-free, and the 80 million you pay tax on. So it's not unusual to have all kinds of businesses not be 1202 companies, but be managed by related 1202 companies. And we think that that's a viable strategy. Okay. Now, let's talk a little bit about qualified opportunity zones. A lot of advisors.
Wait a minute, Alan.
Yeah.
If you have independent contractors, they raise the threshold that you have to send a 1099 from $600 to $2,000. Okay. There is a problem. There's a danger in this. And that danger is there's a lot of companies out there that try to treat all their employees as independent contractors. Why does Uber and Lyft want to treat all their people who operate the vehicles, their own vehicles, as independent contractors? Because they don't have to provide them any fringe benefits that they have to provide to employees. And the problem is that there's a lot of businesses there that they try to treat their employees as independent contractors, especially like when a company provides home nursing care or things like that. And the IRS looks at these and has been extremely successful in treating these independent contractors as employees. Okay? And the danger is going to be with the increase in the threshold from 6,600 to 2,000. I think you're going to see more and more companies try to take advantage of this. So basically, if you have a business where they have lots of independent contractors, the IRS will look at it to see they're really employees. So you got to be real careful there.
We set up a lot of independent contractor arrangements between a company that owns the vehicles used in a business and the employees who operate those vehicles. We make that separate and apart as an independent contractor to the company that provides most of the services but has use for the vehicles and the employees. And if you look at state law in almost every state but California, state law will say that a person can be an independent contractor, whereas the IRS law and the IRS's attitude and positions is that people are an employee. And one really good read is the Bloomberg Tax Portfolio on Independent Contractors. It's one of my 100 favorite books because there's so many examples of how different professions and different occupations could be treated as an independent contractor. So don't automatically say no one can be an independent contractor. Study it, look at it, and see how you can do that. And think about having employees have their own darn car, or independent contractors have their own darn car. Because if it's a car owned by your company and they go get drunk on Saturday night and kill a couple people, your company is in the soup. Okay.
You give them a car allowance, right?
What's that?
You give them a car allowance when they use their own personal.
That's right. Yep. So number 26, the qualified opportunity zone. That they have added, or maybe it was there before, but there's also a rural opportunity zone now. And to make a long story short, on the qualified opportunity zones, if you have a capital gain event and you reinvest just the capital gain amount into one or more qualified opportunity zones, then you won't have to pay the capital gains tax until 5 years later and you'll pay 90% of the capital gains tax. So if I sell a capital asset for 3 million, it cost me 2 million. I have a million of capital gain. I invest the million into a mini storage company or a car wash or an apartment complex in a qualified opportunity zone. Then I don't pay capital gains tax until 5 years, and I pay capital gains tax on 900,000 instead of a million 5 years from now. And then if I sell it more than 10 years from the time I bought it, there's no capital gains tax on the sale. And qualified opportunity zones were supposed to be in poverty areas, but they accidentally ended up being in downtown Tampa, Florida, and other places that were in not such good shape historically, but maybe now. So,
in other words, Congress was very concerned that a lot of these opportunity zones were in areas that were, it was supposedly in a poverty zone, but it was really used in, for high-end areas. Because it was interesting, the poverty zones, the designation of poverty zones are designated by the governor of each state. And so some of the poverty zones ended up being in very lucrative areas.
right.
So Congress was very concerned about this and decided to give extra benefits if you go into a rural area. All
Okay.
right.
So that takes care of qualified opportunity zones. So let's see if there's anything else. Yeah, all the energy stuff is going to be gone. Get your solar panels now. On the I'm putting together a slide, but I don't have it today, on what it means to have Harvard and Yale pay tax based on 8% of their endowment versus 1.39% of their endowment. And it's tens of millions of dollars a year. So it'll be interesting to see how long that law lasts and what institutions that have very large endowments end up doing about it. I think they'll just pay more tax. But it's not 8% of the endowment, it's 8% of the income of the endowment. Harvard's endowment, I think, is about $2.4 million per student, and they have about 15,000 students. So they have a very, multi-billion-dollar endowment. They're going to be paying a lot of income tax. Although I'm paying income tax on 30% on average, they're going to pay income tax on 8% per average. I can understand it, but it's an interesting piece of social legislation, I guess. Jerry, anything we should make sure to cover before we go to some strategies?
A lot of the details are overwhelming, and the nice thing about it is, if you have any questions about the details, call your accountant.
No, just call the IRS.
Yeah, no, call your accountant, because they don't have. Remember, the accountants have, it's not tax season. Oh no, wait a minute. Call your accountant after October 15th.
Right.
I forgot about that.
Yeah.
But what Alan and I tried to do is not just go over the rules and here's all the new things, but show you how to use them. And that's really the key. Is everybody can really end up memorizing and learning all the rules, but the key is how to use all these rules in a tax effective and financially effective manner.
That's right. So on page 18, what this means for a lot of people and a lot of estate planners is you've got to go through just about every irrevocable trust and decide if it's needed, and if it's not needed, what you might do about it. And uh, and basis is going to be the big story here. People are not going to, most people are not going to hit 30 million. So we're going to continue to take great care of clients who are over 30 million or possibly over 30 million per married couple or 15 million per person. But when you have a family that has 10 to 12 million and a 10 to 15-year life expectancy, you don't really worry about the estate tax, I don't think, not that much. They're more concerned with, when grandma dies, am I going to pay capital gains tax, and why? Because I read that there's an income tax step up when someone dies. So grandma set this trust up. When she dies, how come I'm not getting a step up? Why didn't you do something about it? So number A
Well,
here. Go ahead.
let's take a simple situation. Okay? I have a real estate property where the value of the real estate is 10 million. I fully depreciated it, so its adjusted basis is 1 million. So there's $9 million of potential gain. But wait a minute, it's subject to a $6 million mortgage. So if I sold that real estate for 10 million, subject to the mortgage, I would net $4 million and report 9 million of gain and have to pay huge income taxes. So if I gave that real estate if I gave that real estate, and I'm willing to say, hey, I got 4 million of equity, I'll give it to my grandmother, and my grandmother has her full exemption, so I can eliminate all the gain. And I'm willing to use 4 million of my gift tax exemption. The problem is, to the extent that you gave it to the grandmother subject to the liability, you're deemed to have sold it for the liability portion. So you really can't give a negative basis asset as a gift to another individual who's going to die shortly and get the step up in basis at death with no estate tax. So essentially someone says, well, I can't do it because I don't want to pay income tax on the amount of liabilities in excess of basis. So what happens if I give my grandmother a testamentary power of appointment over that piece of real estate? And I'll turn it back to Alan.
So Jerry, is that piece of real estate in a trust?
No, I own it outright. Let's keep it simple. I own it outright.
Okay. Can you give a power of appointment to somebody over something that you own outright?
I don't know.
I've done it, and I don't know if it works. What you could do, Jerry, is you could set up an irrevocable trust that would be disregarded for income tax purposes, so it's separate and apart from you, but it's disregarded. And then you could maybe put $1 million in that trust as a gift, and then sell the property to the trust subject to the mortgage, and that's not considered to be a sale for income tax purposes.
But wait, you're getting complicated, Alan. Let's suppose, for simplicity purposes, this piece of real estate is already in an irrevocable trust for the benefit of my descendants. Okay, it's 10 million of value, 6 million of mortgage, basis of 1 million. So the equity is $4 million. And my 98-year-old mother, who still drives, only in the day, she won't drive at night, okay? How can I take advantage of her unused estate tax exemption?
Well, you could go to the judge. You could go to the judge who has jurisdiction over that trust and say, Judge, I really need my 98-year-old mother's wisdom attached to this trust. She's the matriarch of our family, and we all want to give her the ability to redirect how trust assets are passed among her descendants or to her creditors, but only with the permission of our next door neighbors who would never allow her to do that if it was harmful to the family. And Judge, we gave to your campaign. Would you mind giving us an order installing that power of appointment? And we're going to make her a beneficiary also. And everybody wants to do that. And then the judge gives you that order, and now she has the power to direct trust assets to creditors of her estate, even though it's only with the permission of a non-adverse party who is not a fiduciary. And then on the very sad day that she dies, there's a little bit less sadness because of the step up in income tax basis that occurs under the trust.
In other words, a beneficiary of a trust can have property included in their gross estate, even if the trust was set up by somebody else. So son has a trust for the benefit of my mother and gives her a power to designate whoever gets that property in her will when she dies. So that's a general power of appointment. And if you have a general power of appointment, and you can appoint that to yourself, or indirectly to pay off your creditors, that is a sufficient incident of ownership under the statute to include it in your gross estate. So all of a sudden, my mother, when she passes away, has to include that $10 million piece of real estate in her estate with only $4 million of equity. She has a full exemption, and voila, I get a $10 million basis at death.
Right.
Okay.
So if you could have a fully depreciated office building with zero basis and $10 million of depreciation recapture if you sell it, put that in an irrevocable trust, take back a note, give Aunt Polly that power of appointment, make sure that it does not cause her to be subject to estate tax or state estate or inheritance tax. You can leverage the asset up, and it's right in the Internal Revenue Code. So it's going to be a very common sport. People are starting to ask for it.
Yeah. Now, what if that Aunt Polly has just been diagnosed with terminal cancer and is given 6 months to live?
Well, then you only have 5.9 months to get this done.
Yeah, but unfortunately, people used to do this with charitable lead trusts. They called them ghoul trusts, and the IRS basically took a position that we're going to disregard it when the intention was to eliminate something because death was imminent. In other words, I would not do it for somebody where death is imminent. Okay.
Well, the worst thing that happens is you don't have the step up.
I know.
But I don't know if the case law would work on that. But yeah, we'll have to look at that issue.
Yeah, in the charitable lead trust area, people were setting up charitable lead trusts where the annuity would go to the individual, and then when they die, it goes to their children, and they would go to nursing homes to find terminal people.
Yeah, they were gaming the actuarial rules.
Right.
But this technique that we're talking about doesn't have any actuarial rules.
Well, the point is, I wouldn't do it for someone you expected to die quickly.
Yeah.
All right.
Okay.
But it's beautiful because you can, and when you have encumbered real estate with all that potential built-in gain, in other words, it's not you don't have to have a general power of appointment over 10 million. It's only the equity in the property, which is the value less the debt.
Right.
And you give it a full basis boost.
Yeah. Now, if you're a lawyer and you have your forms, as a lawyer, you have your forms. Your form should say that as to any irrevocable trust formed under this trust agreement, the trustee may appoint a fiduciary to install a testamentary power of appointment as deemed appropriate by the fiduciary, if approved by a majority of the beneficiaries, so that you can install these powers of appointment. And now it's time to go and get them installed. How do you change an irrevocable trust? Number one, you send it to a trust psychologist. That usually doesn't work. Number two, you get a court order. That works. After notice to all beneficiaries, you may have to also have the court appoint an ad litem, a separate lawyer to represent minor and unborn beneficiaries. You may need to set some assets over to the side for them only that wouldn't be subject to divestment under the power. Besides a court order, there's also something called decanting, where you set up a new trust that has what you want, and then the trustee moves the assets from the old trust to the new trust, just like you would decant a bottle of wine, although I've never met anyone who actually decanted a bottle of wine unless they were going to drink it that night or the next night. But decanting is popular if it's based upon state decanting statutes. Third, sometimes you can do what they call a non-judicial modification agreement, where the trustee and the beneficiaries all agree. So this is going to keep the trust and estate lawyers who are begrudging the loss of the exemption to 15 million are going to be doing a lot of trust reformations and changing a lot of trusts if they're on the ball.
Yeah. Now, actually, Alan, there's a very practical reason why you might want to convert. You might want to convert a grantor trust to a non-grantor trust, and it's an irrevocable trust. And you think, I suppose the grantor trust has been in existence for a large number of years, and the assets in the grantor trust have doubled, tripled, quadrupled in value. The trust is 20 years old or something, and it's got like 40 or 50 million dollars or whatever it has, and it's producing all this taxable income. And the grantor has said, hey, that's a wonderful estate plan, but I got a problem. And what is that financial concern the grantor has, even though he shifted a tremendous amount of wealth into the grantor trust?
He's paying the income tax on the trust, and the trust is getting bigger and he's getting smaller, and he can't control what the trust does. It was worth the pain when there was going to be an estate tax to avoid, but now he would just assume have more control and more assets and not be paying taxes for this trust.
In other words, enough is enough, right? They say I'm paying. All of a sudden, the first year I was paying $20,000 of income tax on the trust income. Now I'm paying $2 million a year on trust income, or whatever it is. So essentially, there's a very practical reason why existing grantor trusts that have been very successful in accumulating assets that are no longer in the estate, the grantor says, I don't want to change the beneficiary's enjoyment of the trust. All I want to do is eliminate the power that creates a grantor trust.
That's right.
Now, one little problem. The trustee of the trust is not going to be that keen on it, because if you convert the grantor trust to a non-grantor trust, you're increasing the expenses of the trust, which means less money to the beneficiaries, right?
Right.
So you can't just automatically do it. You have to basically, get the permission of all the beneficiaries. And that's why you could do like a non-judicial settlement agreement or something like that.
Yeah. Right. Absolutely. You've got a lot of fiduciary issues. So, but you may have adult beneficiaries that are willing to take the hit so that their dad can get, back more or some portion of what he gave. We'll talk more about that as well. But there are a lot of fiduciary issues. And as we said before, this non-grantor trust, which is a separate taxable entity, can pay property taxes of up to $40,000 a year and deduct it. Can make payments to charities. If the original trust document does not specifically allow for payment to charity, then in order to get this flow through deduction phenomenon, what you have to do is the trust could invest its assets in an LLC, and somebody else can invest a little bit in that LLC. It's taxed as a partnership, and then that LLC makes the contributions. The trust gets a K-1 for up to for the charitable amount, and that offsets the other income in that entity. So that's the way that would work.
Yeah. Now remember, one of our themes is assignment of income and assignment of deductions to other taxpayers, like the SALT limitation of 10,000 or 40,000. But the typical trust is a trust for the benefit of my descendants. And the typical settlor of that trust has children and grandchildren. And a lot of these grandchildren are under the age of 18. And why would you recommend that the trust, which is in the 37% ordinary income tax bracket, distribute some of its income to these minor children, because they're in a lower income tax bracket? Now, what's interesting, children under the age of 18, if they have passive income, it's taxable to the children's parents at the parents' highest income tax rate. Okay. However, there's an exception. The kiddie tax does not kick in for the first $2,700 of distributions to a grandchild, even though they're supported by their parents, because the grandchild is a separate taxpayer for income tax purposes. They get a standard deduction of $1,700 because they're a dependent of their parents, so they don't get the full standard deduction. But the next 17, they get a standard deduction, I think, of $1,350. And then the first $1,350 of their income is taxable at 10%. So you can have the non-grantor trust distribute $2,700 of passive income to each grandchild. The trust gets a deduction for that distribution, and the grandchild effectively are taxable at a federal rate of 5% on that $2,700.
And you're saving 3.8% Medicare tax on top of that in many cases.
Yeah.
That the grantor otherwise had to pay. And state income taxes.
How many grandchildren do you have, Alan? Not enough.
Just one.
Just one.
Just one. Yep.
But we have a client who has 12 grandchildren, and basically, when I told him about this and shifting $2,700 each year times 12, that's like $30,000 a year, taxable from 37% to 5%.
We were helping a family that had 9 children and 121. Set up a crummy trust and do anything you want. Multiply 130 times 19,000, and that's what they can do each year.
And more importantly, make it a non-grantor trust.
Right. Yep. To their heart's desire, and very charitable, so that works out well for them.
And use it for charitable purposes, use it for assignment of income to beneficiaries in a lower income tax bracket, especially when the grandchild graduates from law school and will start work in September.
Right.
So they're going to have 3 months of income.
Right, right. So on page 20, like I said before, but I think it's worth saying again, you look at what is in the trust, you look at what the client has, and you decide what's best from an income tax standpoint and an estate tax standpoint. Now, one of the things we're doing is we're running numbers for people showing the estate tax based on a 15 million exemption going up with inflation, and then the second time we show it based on if the exemption goes to half in 2030. If there's a Democratic sweep in the 2028 elections, then January maybe that exemption comes back down. So we kind of stress test. We call that the stress test because it stresses clients out. But when I say to clients, I had 2 meetings last week where I said to the client, do you think it may come back down? But they didn't hesitate to say, I think it could come back down. So it's really an art, not a science, as to how much you're going to keep in these trusts, keeping in mind that these trusts typically don't get lost to the next spouse when one spouse dies, and don't get mired in as many of the problems as an individual's personal assets can get mired in. But the fact that this trust owns these assets doesn't mean that it can't swap assets with the grantor. And even if it's a non-grantor trust, you can convert it to a grantor trust, at least long enough to swap assets, and then maybe convert back, maybe not right away. How do you feel about that, Jerry? If I take a non-grantor trust, and the trust protectors give the grantor the power to replace trust assets with assets of equal value, he exchanges some assets, and then the next year he releases that power.
Now the client's going to say, how much did you bill me for that?
And the answer is 2% of what we saved you in income taxes.
The point is, there's a lot of things you can do in advance. By the way, this is where Alan and I kind of have a little bit of a disagreement. But the key is, a grantor trust is an irrevocable trust where the assets in that trust are not exposed to estate tax. So generally speaking, when the individual dies, there's no step up in basis for the assets in the grantor trust, because the grantor trust the assets in the grantor trust are not included in the gross estate. And the IRS in a 2003-2 revenue ruling, which is an interpretive ruling under what the law should be, said there's no step up in basis for assets in a grantor trust, period. Okay. There's some people who still believe you get a step up in basis, but the IRS doesn't agree with that, and that's an interpretive revenue ruling. So essentially, what Alan is saying is there's a lot of things you can do. The swap power, there's general powers of appointment and things like that that you can do. But step up in basis at death is something that you should be very, very concerned with.
Right.
Now,
right.
Alan, one point is, if you have a couple that are not ultra high net worth individuals, they're only high net worth individuals, and they have both 15 million exemptions. One of the problems of putting property in an irrevocable trust is there's no step up in basis at death. Should they maximize the use of both their gift tax exemptions, if they're not ultra high net worth individuals?
Yeah, I guess it depends on what the benefit of that they're using it. Typically not. We always keep a lot of exemption around just as a cushion for all the gifting they may do in the future and discounted sales and things like that.
But also, but like, it doesn't really pay for a modest middle class couple to use all their exemptions while they're alive because you don't get a step up in basis. So reserve, always think about, for people who aren't ultra high net worth individuals, keeping some of the exemptions available at death, because then it's an automatic step up in basis and you don't have to go through all the extra steps that we're talking about. It's just something to keep in mind.
Right. So Jerry, here's something that Stacy Eastland showed us, and it's in one of his, massive outlines, which are always fantastic. But you've got a dynasty trust, a grantor trust. It's got 20 million of assets under a 99% LLC arrangement. They're appreciated in assets. It owes the grantor 10 million. And the grantor says, well, I'll cancel.
Well, wait a minute.
Give me 71% non-voting in exchange for the note based upon a 30% discount. So now, if the grantor dies, you could make a 754 election and get a basis step up on 72% of the assets, right?
Wait, I got confused on the facts. Go back to the original previous slide.
Okay, previous slide.
The balance sheet of that LLC, forget the 1% interest for now. The balance sheet of that LLC shows the LLC with 20 million of assets and a 10 million liability, right?
That's right.
So the equity in that LLC is really...
Well, actually, no. There's no liability in the LLC. The LLC doesn't owe anything. The
trust owns the note. Okay.
There's no debt.
All right. That's what got me confused.
Right.
Okay.
So now he can swap that note using the same discount, 71%, and then on his death, there's no debt there. That's a discount. So then on his death, he can get a step up on 71% of the assets, and they don't really have to move that much. Or he could buy the whole LLC for a note to the Dynasty Trust and get that step up, right?
Well, that I wouldn't do because that has an income tax exposure. But what you're doing here is basically the trust is going to wait. Forget about the discounts. That confuses it. In other words, what the trust can do, rather simplistically, is satisfy its note obligation to the grantor by distributing an asset that it owns to the grantor. That's what step one is, right?
Yep.
Okay. All right. Yeah. All right. So basically, if you look under step one, I didn't see the little note under step one. That's what confused me. All right. All right. So essentially, the individual now has an appreciated asset, and all the trust did was satisfy its obligation with a distribution of property.
Right.
That it owns.
Right.
A very simple situation. All right.
And then,
okay.
Then Stacy says what you could do is have the LLC buy him out for a note, which would be convertible on his death to an LLC interest. And then on his death, $10 million worth of non-voting LLC interest get pushed to him or his revocable trust, and you get that 754 election.
All right.
So that,
I just got a little bit confused on the facts.
yeah, yeah. Now, another thing I want to show, I just want to mention, is we really have to think now. The old model of estate planning for the wealthy is on the first death you fund a credit shelter trust to keep it out of the spouse's estate for estate tax purposes, but then there's no step up on the second death unless you install a power of appointment. So I think the new model is going to be if you don't want to send it directly out to the surviving spouse because you're concerned about it getting lost to creditors or another spouse, you probably put it into a Clayton Q-tip or at least a Q-tip trust that's going to have the marital deduction so that the surviving spouse gets the income and gets the step up. But then I think you have to file an estate tax return, which some people will because of the portability allowance, but people who are well, well, well below 15 million shouldn't have to do that. So I'm just trying to think through what the best situation is. And a lot of people will do joint trusts. And when one spouse dies, you get half a step up. Some people will do these community property trusts where when you die, you hopefully get a full step up, but half of the assets come back to the survivor spouse. And then I think we're going to continue to do a lot of joint exempt step up trusts, which is a joint trust where you do get a step up on the first death. The IRS doesn't like that step up, I don't think, but I think it's a legitimate step up. So we're not going to get into
The IRS doesn't like it, but if you look at the language in the statute, it definitely allows it.
Right.
And there was a very famous case in the S corporation area where the IRS did not like the results under the statute, and the IRS challenged it and lost. And the Supreme Court basically said, it was a case called Gitlitz about 15, 20 years ago. The Supreme Court said, if you don't like the result, change the statute. We can't change you have language there. The plain meaning of the language controls, period. So essentially, the Just Trust does satisfy the mechanical language in the statute, even though the IRS doesn't like it. But if you want to go all the way up to the Supreme Court, you'll prevail. Oops.
How do you spell Gitlitz? Is it Gitlitz?
Gitlitz. It was an S corporation situation where the S corporation had cancellation of indebtedness income. And normally S corporations income is conduit out to the shareholders who increase their basis. However, the cancellation indebtedness income was not taxable because the S corporation was insolvent. So the IRS did not like the fact that you got a basis boost for the cancellation of indebtedness income in your stock, but it was not taxable because of the insolvency exclusion. And the Supreme Court said, too bad. And then a year later, Congress changed the law to say no basis increase for cancellation of indebtedness income that's excluded from gross income.
Yeah. So if anyone, I think there's a lot of irrevocable life insurance trusts, and a lot of people are going to say, I'd like to be able to borrow on that policy, or when I die, I'd like to redirect it. I don't want it to go where I thought I wanted it to go when I set up that life insurance trust in the 90s. So people be very careful of the transfer for value rules, but you could just buy the life insurance policy out for cash or other assets. You could maybe put the life insurance policy under an LLC and buy the 99% non-voting member interest at a discount and owe a promissory note to the islet. Maybe get a court order, these types of things. You could also do a high interest split dollar. So, Jerry, I've got a life insurance trust. I don't like the trust that much anymore, but I want to continue to make the premium payments because I don't want to see the policy lapse or get penalized. Well, the islet will agree to pay me 8% interest on money that I loan to the islet, secured by the policy. how high of an interest rate could I use for this, Jerry, so that when I die, my spouse gets as much as possible?
Well, it's interesting. The everybody says we have to do the related party loans at the AFR. The AFR is a minimum interest rate, and in the statute, in the income tax area, in 163E, I think. Oh God, I'm quoting code sections. Sorry. There's a safe harbor that says if the interest rate does not exceed the AFR plus 5 full percentage points, we will respect the interest as interest and not as disguised principal. It's called high yield debt instruments. So essentially, you have the ability, if the AFR is 4.5%, you can charge an interest rate equal to up to 9.5%, and it will be respected for tax purposes.
Right. Now the trustee may want to get a court order after notice to everybody, making sure that they don't get hurt by a breach of fiduciary duty by paying too much interest, but you don't have to pay it at the applicable federal rate. The applicable federal rate is always below the market rate because the applicable federal rate is based on the Treasury bill rate, and no life insurance trust is going to be as strong as the U.S. government. Even with all our issues, Treasury bills are pretty safe.
Yeah. The legislative history to the enactment of the OID rules in 1990, in the Senate report, it specifically said the AFR is always a below market rate because it's based on 1-year Treasury bills.
Yeah. Now, Brandon Ketron and I did a study for a family, and it wasn't that, there wasn't that much income involved, but there was about $1 million a year of income involved by a husband and a wife, and then there were 4 children. And they were in the 199AA area. They were over the threshold, not getting a 199A deduction. The 4 children were in lower tax brackets. So we were able to set up Section 678 trusts, which are taxed to the children, even though they accumulate assets for Diane, the mother, and have the income divided so that Jack and Diane got as much income as they needed to pay their taxes and their living expenses, so they're happy. Then the 678 trusts get the amount of income that we thought was optimal for income tax purposes. This enabled Jack and Diane to qualify for the 199A deduction. The 678 trust qualified for the 99A deduction and also filled in the income for the children, not subject to the Medicare tax and at the lower brackets. And the savings, $125,000 a year. $125,000 a year. I'm sure we've got another 100 clients that this would fit on. How will I go find them? It will be when I review their charts and their information for planning. Jerry, the CPAs who really open the file and think about this and meet with the client and call in the lawyer and the financial advisor, they're fewer and far between. Do you think another profession is going to take over that function? Or where do you think that's heading from a professional and a teamwork standpoint?
The AICPA has been trying to educate the accounting profession to say, you're not going to do the legal work, but you're going to come up with the ideas. And you have access to all the financial information. The lawyer doesn't have access to, you do the tax returns every year. The lawyers don't do the tax returns, and they don't really think about that. So but going back to what Alan has said, we're talking about assignment of income to taxpayers in a lower income tax bracket. Now, the easiest way is for the 2 seniors, the 2 parents, to make taxable gifts of interest in this business to their children. But that means taxable gift. However, but what Alan said is, can we set up a trust for the benefit of my children and have it be a grantor trust as to the children? And Alan has basically called it a 678 trust. But the key is a trust that is subject to Code Section 678 says if certain conditions exist, the beneficiary of that trust will be treated as the grantor for income tax purposes only, even though it's a separate trust for transfer tax purposes.
Right.
So
Jerry, I've got 2 minutes left in this 2-hour program. It's gone so fast, and then we're going to have another program to show off Estate View that starts in 15 minutes, and it's the same. Everybody can just stay on. Some people are going to join us, but we don't have to shut down and start over. But I just wanted to, in 2 minutes, you can go, if anyone, just to see some numbers. So you got Bob, and he's male, age 57, so he's got a life expectancy of 35 years. He's a non-smoker.
Well, let me say one thing, Alan.
Yep.
One of the problems when we describe all these esoteric techniques orally or in a PowerPoint or the client can have a little bit of a problem understanding it because we use terms like islets and grits and all that other stuff. So the easiest way to communicate what you're doing in an understandable manner is to use simple to follow examples. And what Alan has done is develop Estate View, not as a planning mechanism, but as a communication mechanism. And that's the key to Estate View.
Right. So you go into Estate View, and you only have to fill in the yellow fields. So the yellow fields tell me about his life expectancy, his age, and then I go to his spouse. He's 55, she's 50, and then I find out how many children they have and fill in the number of children they have, and I can always remove their children if I want fewer children, which they can't do, but I can. And then really important, how much are they saving a year? Because if they're saving a lot per year, that's going to add to their estate. So he's going to save $400,000 a year until he reaches age 70. He's going to then slow down, and then when he gets to 80, he's actually going to spend more than comes in. And then I do the same thing for her as to what happens after his death, and then I find out the value of their home, $2.5 million.
Well, go back, Alan.
Yep.
Alan, go back. The savings. What you are doing is showing that it's not your current net worth, but you're showing if I'm going to be saving money and I live to a certain age, what is going to happen to the amount that I have that's exposed to estate tax?
Right. That's exactly right. And then their home value and a growth rate, their vacation home value, a couple million and a growth rate. IRAs, 3.7 million, growing at 7%. Her IRA, 3 million, I can say 3 million, growing at 7%. And then their non-IRA investments, 20 million, and a little business that is worth 3.5 million that may sell for 10 million. So, it doesn't seem like they have a lot. They're at about 30 million. And are they charitable? Yeah, they would do a charitable lead annuity trust. So then we go ahead and run our calculations. And here's where they are today. 30 million of investments, 4.5 million in a residence, a little bit of life insurance. If they die now, a little bit of estate tax. And if they die in a year with a 15 million exemption, you'd have 2.3 million going to you'd have 3.8 million going to a charitable lead annuity trust. Not much to worry about. No estate tax, and after 20 years, the kids would get another 1.5 million. from the charitable lead annuity trust. But what happens if they live to their life expectancy without any planning? Now you have a $120 million estate tax. So they really do need to do some planning. And if they fund a credit shelter trust on the first death, only 109 million of estate tax. If they do Cuperts, 91 million. So you see a couple with 30 million really needs to do the planning, but I can go back and I can cut them back to a much lower net worth. I could just crank down their investments to about 10 million. I can click results again. I can go back to married couple comprehensive. Now they're out of harm's way if they die this year with 21 million of investments, 4 million 5 in the residence. But again, with no planning, you're looking at $80 million of estate tax.
Here's the key, Alan, is you show what would be done if you did no planning, and then you show all these different things that can be done. You don't have to do everything at once, but you can basically illustrate all these different things that can be done. And what happens is, all of a sudden, all of a sudden, the client will say, let's not do this. I don't want to do a charitable lead trust. Let's not do that. Or I want to do this and that. Or I want to change the assumptions. The client will participate with you in making the decisions as to what techniques to use and how to finance all the different techniques. So you get the client involved in understanding the process with simple to follow numerical examples. That's the key.
That's right. And the timeline here shows, yeah, you don't have an estate tax problem until 2023, and then it may be too late to deal with it. So maybe there's no problem until you work with it. Maybe there will be. But what if the exemption goes away to 50%? What if it doesn't? So lots of dynamic planning to do. So anyway, we'll end this now. Jerry, thank you very much for attending the first session. You're welcome to join the second session, which is in 11 minutes. I think there will be a lot of biological activity going on between now and then.
Yeah, well, Alan, I have to record a class now for Boston University, so I will. But will Brandon be able to carry you in the next one?
I'll just use the puppet.
All right.
I've got some programmers joining me, but great to see you, Jerry. Thanks so much, and I'm looking forward to spending some time in New York.
That's true. And by the way, if anybody wants to listen to the Advanced Trust and Estates thing on Thursday and Friday, it's virtual.
Yeah.
So,
is it live?
It's both live and virtual.
Oh.
And she warned us that there might only be a dozen people in the audience, but there'll be about 50 or 60 virtual or more.
Perfect. All right. Take care.
Thank you, Alan.
Yeah, my pleasure. All right, so I'm going to turn my camera off here for 10 minutes and look forward to getting back with you very soon. We're about getting ready to start here. It is 1:15. I'm Alan Gassman. Welcome to this presentation. And what we're going to talk about, and I may be joined with one of our engineers, I may not. We'll see if he can come aboard. Let me fix my camera. And this presentation is on using Estate View after the Big Bad Tax Act. I'm going to show Estate View here on my screen. Estate View is a software program. It's housed on the Amazon cloud. When you access Estate View, it comes into your computer. You're not coming into our program, we're coming into your computer. The data that you give us or that you use, made up names or real names, comes out of your computer nothing is stored on the Amazon cloud. Everything is stored on your computer. So when you save anything so that you can come back, you save it to your computer, as I will show you. One of our latest features that I want to just start with is the AI. So what we've done is we've contracted with the company OpenAI, as most of the other software programs do that use AI in a closed environment. And we have provided OpenAI with protocols to handle a number of different types of documents. And the first one that you could do here is you could put in a federal income tax return. You could sterilize it, or you don't need to sterilize it because of the way that the Amazon cloud and OpenAI are contracted to keep it all within your computer. And as a result of that arrangement, it views the tax return in what they call chunks, looking for the data that it will process, and then eventually you'll get a response. And what we've done is we've programmed Estate View to first ask for an executive summary and then an analysis of the sources of income, which I like for the estate planning because it tells me what banks and brokerage firms they're getting money from and how much, so I can get an idea of approximate size. Then it goes through a deduction analysis and describes the deductions that the individuals took on their federal income tax. Then it goes through a charitable giving analysis explaining what the charitable giving opportunities of that client were in that tax year. It does go through Schedule B to make sure you get the Schedule B information, and then it summarizes the discussion. So what we did was we put in Joe Biden's tax return. That's the sample document. Now, across the top, when I click on View Document, it shows me the document I'm looking at if I want to see it, or I could print it if I want, or I can hide the document. And then it's going through, it's telling me their names, it's telling me they filed married jointly. They had 485,000 of salary income, 39,000 of other income. It's kind of spitting the information out as it goes along. I see their itemized deductions. I see their interests. I see their foreign accounts and a summary of their interest and dividend information. So this is useful to me as a estate planner, and also just to understand their tax return information. Now we are working on. Oh, I'm supposed to share screen. I'm sorry. So nobody sees what I'm doing? Oh, that's nice. Okay, so let me click on share screen. Sorry about that, everybody. So let me find where I am. There I am. Okay, now I'm sharing screen, so I'll start over. I put in Joe Biden's tax return. I'll show you how I did that in a little while. And it showed me an executive summary, an income analysis, a deduction analysis, charitable giving analysis, and a Schedule B analysis. And I will go ahead and download this discussion, so if you want to see it later, I've got it as a Word document. And what it shows me is the client's names, what their income was, how their tax calculation worked, what their itemized deductions were, what their interest and dividends were, what their effective tax rate is. It explains standard versus itemized deductions. It reviews what the deductions were. It reviews their business deductions by amount and category. And then it provides optimization opportunities. It talks about bunching. It talks about charitable giving. It talks about business expense planning. Then it goes into detail on the charitable giving and what their limits are for charitable giving based upon their adjusted gross income and itemized deduction situation. Again, it breaks down interest and deduction and income, and then it summarizes the whole thing. Now, the next thing it will be doing pretty soon is write a letter describing this tax return to a new CPA who has not seen it yet. And now OpenAI will take the data and take what it's done, and it'll write that letter. There it is. It's almost instant. It's pretty fast. And this is telling, as I said, this is telling a CPA what I think the CPA needs to know about the tax return. Here's another question. How much could they have put into a private foundation that is a non-operating foundation that would be deductible in the year donated if they donate appreciated stocks? All right, I'll ask that question, and there's the answer. It talks about deduction as a percentage of AGI, fair market value consideration, carry forward consideration. It did not give me an exact number because I have not trained it on this one. Sometimes you never know what you're going to get. Then I can click on analysis tools, and it will be able to give me whatever I've programmed as far as that. So how did I get here? Because I'm sorry I didn't have my screen sharing. I go home. A lot of you are at home now. And then I go to AI document review. And then I clicked on tax return. And now I could either drag and paste a tax return into this, or I could choose a file. I can click on choose file, and then if I have a tax return that I have in my computer as a PDF, I would just be able to click on it, or I can try a sample document. And the sample document I have is Joe Biden's tax return. And now I choose, do I want an executive summary? Do I want an income analysis? Do I want a deduction analysis? Do I want charitable giving analysis? Do I want a Schedule B analysis? And the next one, which is coming up soon, we'll have it next week, prepare a comprehensive letter to Mr. and Mrs. Biden explaining their tax return and how the tax system works. I click on that, and now it's going to work. It's going to take 3 to 5 minutes. While I was talking, it was preparing these, and it will prepare these one at a time. So, as far as printing, I can click on print discussion. That's what I did, and it would print it, or I can put download discussion into a Word document. So I can go back home and just point out to you that we're pretty darn good on reviewing estate and trust documents. We also review employment agreements, buy-sell agreements, life insurance, both life insurance policies and life insurance illustrations. And you're only using AI, but it's you can be assured that it's not learning from the data you send. That data stays on your client's computer. On your computer. It does not go into the Amazon cloud. So pretty nice technical development. And we've had a lot of good input, a lot of praise on the trust analysis that it does. But it is AI. So you have to read every word and make sure the client knows that that's what it is. So Mason, have you joined us?
I'm here.
Okay, great. So
You hear me okay?
I hear you fine. And you're not going to be able to share camera?
Let me see. Here I am.
All right. So this is Mason Hawkinsmith. He's one of our engineers. And
Hi.
he's enjoying a nice afternoon near a Starbucks, which is what engineers like to do. And Mason, if you heard what I just said about the AI, do you have any comments or anything you'd like to share about that?
No, not at the moment.
Okay. So now what Mason has been working the most on is Instant Plan. So we'll go to Instant Plan. An Instant Plan, I have to admit, for the last 4 months has been like the Florida weather. It changes every 45 minutes. As we improve it, we put it onto the system so you can use it. It's always been functional, but there will be changes here and there. By the end of July, every page you would go to on Estate View and Instant Plan will have an instructional video. So no matter where you are, you'll click and see the instructional video, which will walk you through what you're doing, because you can stop and start the video and do what you're going to do. So the buttons here I have are number one, customize form. And that's if you want to make your own customized intake form. We are offering a free, of course, fillable PDF intake form that you can use. You can private label this form, give it to the client or give it to an assistant. They fill it in, and then it automatically transports into Estate View. Now, some clients like to do things in handwriting. We're not yet converting handwriting into Estate View. I imagine we will be able to eventually, but I think most of our licensees are just going to use our form. So there's two other buttons here. Number one, just get started, or number two, view clients. Well, I'll click on view clients. And when I click on view clients, it has been listing and keeping track of these 5 clients on my computer. One is a fictitious version of Marcia and I. One is Bob and Mary Sample. One is Jordan and Basie Fish. And I can just click on Bob and Mary Sample, and then I can open client data, and there they are. So the data, which is stored on my computer, has now populated, as they say, our Estate View questionnaire. And as most of you know, in the Estate View questionnaire, if you just want to crank numbers, we only need the yellow data. And that means we only need you to give us data for the first 1, 2, 3, 4, and 5 items on the left. And then if you want, you can go to assumptions and affect the assumptions. So let's look at that first, just what happens with the data. It's good to have.
Yep. Alan, do you want to set it to the calculator only view?
Oh, can we do that?
Yeah, go up to settings at the top.
Yep.
Click that. Now on the bottom right, do you see where it says this client, or the bottom left, sorry?
Yep.
Click that drop down, and you change it to calculator only, and click save. The bottom right.
Okay. Beautiful.
And now you've just selected one of our preset templates. So you can make your own template, like if you didn't want to ask for the middle name of your client, but you wanted to ask for anything else, you can do that. You can add and disable, any of the fields that we have available. But this one is just the calculators.
Right, and I would suggest you not change this one because this is the only data that we're going to work with. So as you can see, I've got client name, male, female, date of birth, or I can just specify an age, how much of their lifetime gift exemption has been used, and the expected retirement age, married or single. If it's married, then there's no other spouse to deal with. If they're not married, if they're married, there is. And here I've got spouse's name, sex, date of birth, exemption amount used. All I have to do is toggle up and down or type it in. By the way, if I wanted to type in 1 million, I could type in 1M as in mother, hit return, and it's a million. Or if it was 75,000, 75T, hit return, and it will be 75,000. Okay. So then I want to know their children, and we ask the children's names. We don't necessarily need the children's names. And then do they have great grandchildren? And then we use this to know how many crummy powers they have for gifting purposes. And then next, I go to key financial data. And by the way, to get to next, to go from page to page, I can go to the top left and go back to family, or forward to key financial data, or I can go to next there to get there, and previous there. And right now I'm on financial data. That's the dollar sign there. If I wanted to go back to people, I could click there. So there's a lot of ways to get where you want to go. So on the key financial data, I want to know how much are they saving a year until what age. So he's going to save $350,000 a year till age 71. After that, he's going to save $250,000 a year till age 80, and then he's going to spend $300,000 a year. Now, this is not his taxable income. This is how much more he earns from outside sources compared to what he spends. So his salary plus Social Security minus income taxes is and minus spending is $350,000. And then we made this cute little chart there on the right, and as you change it, you see the chart change. And then next, if after his death, depending upon the year of his death, what will Mary's situation be? And if she's not the bread earner, it may be more spending. What's their house worth? And what's the growth rate on the house? What's their second house worth if they have one? What's the growth rate on that second house? What's his IRA and pension accounts together worth? And what's the growth rate there? And we'd like to know if they want to tell us what's the ratio of stocks to bonds. When you click on one, the other changes. What's her IRA situation and stock bond ratio? And then for investments outside of the IRA, do you want it to help you add them up? In which case you would just put these all in separately and it would add them up. Or do you want a total value only? And Mason, I think we should put the total value only button on the left, because most people, when they're doing the calculator, I think they just want to put in the total. So
Got
the
it.
total, yep. So that's one little change there. And by the way, if you want to send us a question or an email, let us know what changes you think we should be making. We will do that. And I think that this should go up and down by $1 million increments when I'm clicking it up and down for the non-IRA investment value. So then I've got my stock and bond ratio. Also, by the way, investment costs per year as a percentage and tax costs per year as a percentage on the non-IRA investments. And then I can have one other asset. So this could be my professional corporation that never goes up in value, or it could be an exploding asset that will go up in value. And we'll also track how much income tax will be paid if it gets sold, and based upon sale in, let's say, year 6. So my next category is very simple. Would you consider a charity if it would save you estate tax? And the answer there is yes, I would like to do a charitable lead annuity trust. Okay, so now I can go to assumptions. And in assumptions, I rarely change this. I rarely go here because I know what it is. But this is telling me what my estate tax rate is, what my gift tax rate is, what my assumed inflation is, what my chained inflation, which is less than real inflation, is expected to be, because that's what the estate tax exemption is geared to, what my capital gains rate will be, how much the client wants to have per year in income in $2025 when they retire, how much of an estate they would like to leave for their descendants, what year that they would like to be able to retire, not necessarily that they will, but they would like to be able to retire. And then which estate tax strategies are we going to be using and showing, and under what assumptions? Okay, so then I can go to review summary, and I can look at all this information. I could download it, send it to the client, and then the client can tell us if they have any changes that they want to see. And Mason, it seems like if you clicked calculator, you would only want to see the information going into the calculator here. That may be another nice thing we can change later.
I think it
So
is partially true, but we added some new stuff, and so it's not working. I just
right,
scroll down.
okay.
So
So
that's
then
something.
I click on results. Once I have this, by the way, if I saw something I want to change, it's simple. I just go to key financial data, and if I heard that the client says no, this 400 should be 450. Okay, I change it. Click results. All right, so it's just run 40,000 calculations. Most of them are the Monte Carlo simulation, but the most popular thing we have is the married comprehensive. Most people want to see married comprehensive. So here we see a $28 million net worth, $4 million in real estate besides that. And if they die in 1 year in 2026, they're going to be at 33 million with a or a little bit more than that with a 2,500,000 estate tax. But if they let us do annual gifting and an installment sale and a charitable lead annuity trust, there will not be a federal estate tax. $1,700,000 will have to go into the charitable lead annuity trust. Well, maybe they are, maybe they aren't that concerned with estate taxes. And let's give them less, we could give them less concern. We could go to key financial data, and we could say that the assets outside are much lower. Move those way down, go back to results, hit married couple, and now they really don't seem to have much to worry about, do they? Their exemption when they die is much higher than the value of their assets. So they're below the exemption with 27 million. They're not that concerned about it. But Estate View also knows that the husband has a 24-year life expectancy, the wife has a 36-year life expectancy, and based upon the data they gave us, you are looking at 175 million on death and a $48 million federal estate tax if they don't do anything. And I can quickly show them that a bypass trust saves them quite a bit of estate tax, 7 million of estate tax. So it's good that I'm drafting that. And if they could do 2 Cuperts and put their homes into qualified personal residence trusts, it automatically assumes that the term of the Cupert will be 80% of their individual life expectancy. And then they'll pay rent based upon 8% of the value of the property after the Cupert term runs. Those Cuperts will have a lot of value here, 36 million of value out of the estate tax system on the second death. Or if they do annual gifting, then the annual gifts to a trust without discounts would put another 19 million outside of the estate tax. If they do discounted annual gifting, it will push another 8 million out of the estate tax by gifting LLC interests instead of regular cash gifting. Then life insurance trust planning, which I'll come back to, a large gift of a third of their investments through an LLC, rolling grats, an installment sale, and they're at zero. So I could go back though and say, well, these people are in California. They're not going to want to do Cuperts because they'll have to pay too much property tax. So I'll go back to assumptions and I'll say, I don't want to do a Cupert, no Cupert. And also, they don't want to go through the annual gifting thing because they think that that's too much of a pain. So I will take out the annual gifting. They're willing to gift 44% of their assets to an LLC for a large gift, if that's within the exemption. And then they're willing to put, let's say, 4 million into rolling grats. So now I click results again. I can go straight to married comprehensive, and I can see where I am with no planning, still 48 million. With discounted gifting, if they wanted to do it, 41 million. Large gift, a larger gift, they're at 23 million. Rolling grats puts them at 18 million, and the installment sale, after the installment sale, still a tax. If you don't do the gifting and the Cuperts, then you do have to do the clat. So in what, 10 to 12 minutes, I've got a pretty good feel of their situation. So I can either now click and get a comprehensive letter describing all this, or what I prefer to do is I can go ahead and save this to the calculators right there, and then it's going to load all this information into all of these calculators that we have. I'll click on save. Okay, so now I will go back to home. Where's home? There's home. There's no place like home. And then I go to married clients, and there's their information loaded in. 4.4 million in residences. There's their investments. I'm seeing the same things here, but I can easily adjust any one or two items on the left. For example, they didn't want to do a Cupert, but let's say they're going to move to Florida where they can do a Cupert. I can just click on that, and then I can show them the Cupert. The other thing, I'll click back off Cupert. The other thing I can do here that I wasn't able to do otherwise is I can view this as a timeline. So I can show them on the timeline, look, you really don't have an estate tax problem until 2028. The question is whether you want to do something about it now. And another setting I have, and I should have mentioned this, is it's assuming that the estate tax exemption is going to drop by 50% in 2030 when the Democrats get elected. When I turn this off, the problem is less, but there's still a problem. And I personally like to, if I can, and if it doesn't hurt anything else, I like to stress test these plans so that I know that the estate tax is handled even if the exemption goes to half in 2030. It could go to half in 2034. We don't know when, but it certainly can. So that's the married couple calculator. And as most of you know, with the married couple calculator, I can go up here and I can generate my client letter and click there. And now it's writing a robust letter. I'll save it, so if any of you want to see it, you can read it, give me suggestions to improve it. And then I can also click share with client and then send them a HTTP address with a code by email, and then they'll be able to use this software module with this preloaded information for a period of 12 days. So I can send it to the CPA, send it to the financial advisor, send it to their brother-in-law who's an engineer, and get everybody using the estate view and making the best of the estate plan. So I can also go home, and I load it in just to show you. Here's all these Cuperts already loaded in. So it's showing them 4 Cuperts, two for each house, one by husband, one by wife for each house. And then if I want to run a different scenario, like I want to take Cupert number 4, which is showing me a 100% by spouse number 2 of the home, and the term of the Cupert 15 years, which is 84% of the life expectancy. Well, I'd like to see a 20-year Cupert. What would a 20-year Cupert look like? And then you see there, if you go 20 years, I can compare 20 years with 15 years, and the amount of exemption used is going to be different. Instead of a $1.2 million gift, it's a $942,000 gift. And then I can click on general explanation, and I can say I want to see a PowerPoint on Cupert number 4. Click there, and then Cupert number 4 comes up as a PowerPoint. It isn't there yet. I guess it's being prepared, or let me just click it again in case I didn't. Oh, I got to click PowerPoint. That'll help. Click Submit. So now it's creating those PowerPoints, which will be at least advisor-friendly PowerPoints explaining all the assumptions and step-by-step how a Cupert works. So there it is as to the specific Cupert that we just worked with charts and helpful information and tax planning and the spreadsheet and the whole thing. And if you are not, let me see where estate view went. I lost estate view. It's got to be around here somewhere. There it is. All right. So if you're not familiar with any of the calculators, just open up the video there at the bottom left, or move it anywhere you want it. Watch it while you do the calculator, and the comments on that have been good. I can always go back to Married Comprehensive now, or I can go home. So those are convenient buttons. And now I'm going to go back to, see, it always will take you back to where you were last time. Now I'll go back home, and I will go back to Instant Plan, because that's what most of you like to see. And I will go back to the View the Client, and I'll go back to Mary and Bob where we were. I'll open them up, and now I'll just show you when I click Results again. So I'm back in my settings. If they're not estate taxable and you're running numbers, then the nest analysis is very useful. And this is a short form analysis. Here's their ages. Here's where he would like to retire at 63. Current investments. And we know it's the savings information. And I think, Mason, we should probably add the savings information to this screen. How much they're saving a year, how long. But they're going to need $33 million at retirement to generate, assuming a 4% payout, to get to where he wanted. He's $12 million short. So he's going to have to reduce the income expectation, or he's going to have to work longer to get there. And this shows that the plan's going to fail in 2038 based upon what they were planning to do. And those are the numbers. Now, again, I can go back to my home, and I can go to the Nest calculator. And in the Nest calculator, I can click on Pro and click on See Results. And now there's a spreadsheet showing me each of the items that would be kept track of, and when he wipes out and goes into the negative, and also how much life insurance he needs each time, at each year, to be able to achieve what he wants to be able to do if he stops working and he dies and expenses stay the same. Now you can see a lot more things by opening these items up in the spreadsheet, so that you can show the couple, here's all the things that go on to interact to see if you have enough assets to retire. And then across the top, it's showing you you're 10 million short, or you need to work until 68. If he keeps working until 68 and saving, then he'll make it. But you may say, well, let's look at an alternative. I'll hit duplicate. And what if you only really need $1,425,000 after retirement? And what if your children really don't need as much? What if we reduce what we think your estate needs to be? And what if you can save some more? So they can get an idea by this spreadsheet, and then they can also add different things, like we forgot about our church pledge, we forgot about college, we forgot about the inheritance coming. You can, the estate view, you can add each of these items, and then that will build out another column in the spreadsheet, and then you can export this into Excel. So this is how Marcia and I did our planning when we did our first estate financial plan with a financial planner in 2003. He did it all by spreadsheet. So all we've done is we've built a spreadsheet around that. Now, you say, how much is this life insurance going to cost? I click on Life Insurance Estimator. It knows the name, it knows the age, it knows smoker versus non-smoker, and it will tell me how much per million the life insurance will cost. So I'm going to go back to Instant Plan now. And I'm going to show you, and I'll just go back to where we were again. And I will go back to have a little internet thing going on there. Okay, so go back, get started. Here I am again, where I was. And now, Mason, I want to get back to the robust treatment of them. So where do I go to that? I go
So you just go back to the settings menu at the top.
Yep.
And where it says calculator only in the bottom left, just switch that to all fields.
All fields.
And then click save.
Click save. Do we have to click save? Can we avoid having to click save in the future?
Yeah, I can remove that. So it just saves automatically.
Yeah, have it save automatically. All right, so now I'm going to go back, and now I can put some robust information in. So everything that's not yellow for my estate planning process, I can ask them about burial. I can ask them about health issues. They can tell me if they have any particular, if they have a good doctor. If not, I can recommend one. Same thing for the spouse. Same thing for the family members. If they want to give me this information, they can. And then on the financial data, they can give me specifics as to accounts and information and things like that. So now I'm going to get all of their financial information. They're going to tell me about the charities they're interested in. They're going to tell me about their life insurance. And by the way, I can add a life insurance policy. I can say, I recommend that you, in a life insurance trust, buy a permanent policy. And here's what it's going to cost. It already knows what it's going to cost, and I can add that to what I'm doing to show them a before and after. Then I can get all sorts of information, and I'm going to show you a chart pretty soon where the information ends up. But everything here is pretty much anything that I would need to receive from a client in order to do their planning. It's a very robust intake arrangement. And by the way, I can email this to the client, and they can put it in a portal. I can also, besides talking about liability insurance, advisor information, fiduciary selection to get them thinking before they meet with me about who they may select, I can also say, hey, I see you have a 16-year-old grandchild. You think he's going to go to public or private school? Probably private. You think he's going to go get a law degree? Probably private school. What's it going to cost to feed and clothe him during all this? Well, how about, this is kind of clicking weird. I'll just say $30,000 a year. Oh. So This one has a mind of its own. So 30,000 K. All right, well, forget living expenses. So then how much do I need to save right now for his college? And it gives me that amount. So now I hit results again. And go back to results. I don't know if it's internet or what the situation is here. Go back to previous. It's kind of stuck on college. Okay, so I'll click on results. And now I'm going to generate a planning chart. So do I want to see their assets without any trusts, or with a joint trust, or with separate revocable trusts? I think I'll show them their assets and separate revocable trusts. And now I open that, and it opened on another screen. But this is probably the most valuable thing that Estate View does for us, especially for the non-estate taxable. Now I have a robust presentation for when I meet with them on Zoom or in person, which gives me their required minimum distribution numbers and a view of what their pension plan will probably do, either with or without charitable distributions. And then I can show them this tax savings if they do charitable distributions. And then I have all their assets, his assets first on the left, his future revocable trust, his age, his life expectancy, his entities below him, below that, who owns those entities, and what's in each entity, and then what their joint assets are, what her assets are, IRAs, who owns the cars, what are the life expectancies, and then her minimum distribution planning, and then their children, grandchildren, great-grandchildren, fiduciaries and friends, a red flag report, like, why are you letting this child drive your car? Why isn't this investment property in an LLC? Do you realize that your German Shepherd is causing you not to have insurance on the house if he bites anybody? Your 22-foot boat needs a separate umbrella. Also, a family tree. So now the client sits down with me and we go from left to right, item to item, and I take my notes right into this. They see me typing my notes while I'm talking about each entity, and they're taking notes. Or if they meet me in the conference room, this is on ledger-sized paper, 3 pages. They have it, I have it. It's a really good planning tool. In addition, I click Export to Excel, and I have an asset allocation report and a more traditional summary of assets, which I've opened here. So this tells me asset by category, by spouse, with totals, with liabilities. And it will also tell me anything that's a foreign asset or anything that is a community property asset, which is, of course, good to know. Estate View asks them towards the end of the questionnaire, which of all these assets are community property? Which of all these assets are foreign? So I won't forget to do that. And then also an asset allocation picture. This is their main asset groups, pro rata, and with the size pro rata to what each asset is. And then a personal financial summary. Within about a month or two, this will be a personal financial statement that they'll be able to export into a Word document or a PDF. So that's also a nice deliverable. Um, the points of discussion is where we're putting in all these red flags as far as, hey, you're going to inherit from your mom. Shouldn't she update her estate plan? Hey, you're going to support your father. Should you have a separate trust set up for him? Should you start be doing Medicaid for him? You've got the boat. You've got a silencer on your gun. Do you need to go ahead and set up a gun trust so that other family members can use the silencer? Anything that you would like to remember to cover with a client with respect to their planning, we will appreciate you telling us what it is in case we haven't thought of it. There's also a letter writer, which can talk about attorney-client privilege, conflicts of interest, joint representation, business purposes for what we're doing, how an installment sale works. Most of what I would ever write a letter to a client about is set up here, including making referrals to other professionals so that I can just go through and click what I want or tell my secretary what I want, and then the rest can come out. So, Mason, we've pretty much covered what I wanted to cover, and I had promised that this would only be a 50-minute presentation. So I've only got 5 minutes left. I'll mention we're almost ready to say that the life insurance organizer is not in beta yet. And with the life insurance organizer, you can take the life insurance on the first spouse, and then the life insurance on the second spouse, and then the second to die life insurance, and it'll all line up into a nice spreadsheet, which will total each category and provide reminders, and then this will populate into the instant plan and into the rest of Estate View and into a nice Excel spreadsheet. So you can sit down with the client and say, here's what you have. Here's what we think about each of these policies. On this term policy, it's going to expire in 6 years. What are we going to do about that? When is your convertibility option done? And things like that that come up. So that's coming up well. Another one that we're going to have, I would guess in 10 weeks, maybe sooner, it is working, is a required minimum distribution calculator for eligible designated beneficiaries. So if you're going to leave the IRA to an accumulation trust for the spouse, or you're going to leave the IRA to a accumulation trust for a disabled or chronically ill individual, it will show you the results so that you can compare the different techniques while you are designing all this. So let me see if there's any questions here. I don't see any questions. I guess everybody already fell asleep. Mason, anything you want to add?
There were some questions.
Oh, okay. Let's go through them. I didn't see them.
Let me see.
Nice. Question thread.
So Chris Rose said a few suggestions. One, when showing CRT, can the software compare the benefit of the CRT with payment being subject to tax and reinvested after tax versus just selling asset, paying the tax, and investing the funds immediately?
No, but I'm working with Jerry on the next generation of that, Chris, so maybe you can help us out with that, especially if you have any samples where you've done that on a spreadsheet. We'll be glad to add that to Estate View because it's a great idea.
Here's another idea from Chris. Do a calculator of giving appreciated assets to foundation or DAF and benefits versus just selling assets and making a gift.
Oh, that's great too. Okay, we can start working on that. That's a good one. Mason, you have lots of job security.
Oh, here's another one from Chris from right now. Show a calculator to compare an IRA primary to individual versus using a CRT for 20 years payment.
That's a good idea too. We can show a 20-year CRT, but we're not showing the income tax part of that yet. So all great ideas. Chris, maybe we could do a presentation on those 3 things. Let me know when you're ready to do a webinar because we need to do the presentation so that Mason can watch the presentation to see what we're talking about. Any other questions?
think we got him.
Okay. Oh, no. Okay. Very good. Well, I appreciate everybody's questions, comments, and suggestions. Appreciate that you spread the word on Estate View. Oh, I want to show off our website. Mason and his friends have done a great job on the website. So you go to estateview.com and you open it up there. And then when you page down, I've never seen this on a website, but you get like a simulated instant view. So you can actually click on things and see what they'll do without being in Estate View. So I thought that was really neat. You can click on that and kind of get an idea of what it's doing. And but also on the website, make sure you go and see our videos. You click on videos on the website, and then there you go. You can watch a video on each of these subjects and see how the calculators actually work. So again, thanks everybody. Mason, appreciate you working on a Saturday. Looks like you're in a nice place there. And I hope everyone has a fantastic rest of your weekend. Thank you.
Thanks everyone for coming.
Take care.